Macquarie Group has announced a net profit after tax of $1.4 billion for the half year ended 30 September 2023. 65% of income was earned outside Australia. The group declared an interim ordinary dividend of $2.55 per share. Shemara, thanks so much for joining us. How did your annuity-style businesses perform in the first half?
Well, look, pleasingly, we were able to grow our franchise in both those businesses, in banking and financial services. We continue our disciplined growth through our digital banking customer-focused offering, growth in our home loans, our business banking, our funds on platform and our deposits. And then in Macquarie Asset Management as well, we saw good ongoing growth in our fundraising and our assets under management and equity under management. And so our base fees and performance fees were broadly in line, but a big driver in the movements to the prior comparable period, the first half of last year, were that we had material realisations in the green energy assets in the first half of last year. And in this year, first half, we're holding those assets for a green energy fund that we're launching. So that caused a material change in net other operating income.
And how did the operating environment impact your markets-facing businesses?
Well, again, it was great to see the ongoing growth in the franchise in both of those. So in commodities and global markets, we continued to grow our client numbers across the business and had consistent results from our financial markets and asset finance businesses. But in the commodities business, we had lower results compared to the first half last year due to the fact that we didn't have the same levels of volatility in certain areas, particularly European gas and power and resources in the risk management revenues, and North American gas and power in the inventory management and trading. And then in Macquarie Capital, again, ongoing growth in the franchise with the fee revenue broadly in line with where it was in the prior comparable period, but the investment realisations in equity were less because we took advantage of the conducive market last year, but that was offset by the credit investment book growing. So again, a pleasing result.
Now, you've announced a share buyback. What drove that decision?
Well, you'll recall that last financial year, FY23, we had exceptionally strong results, and FY22 was also a very strong year, and that has resulted in quite a step up in our surplus capital. And in addition to that, we see ongoing growth in the surplus capital from our earnings net of dividends. So we feel we're very well positioned to support opportunities that our teams identify net of doing this capital returns. We feel we have capital above our needs, and the prudent thing to do is return that to shareholders.
So how do you see the outlook for the remainder of the year and into the medium term?
Well, over the medium term, as ever, we remain confident that we're well positioned with our franchise of 4 businesses that are very diversified in terms of the thematics they're exposed to, but also structurally well positioned for growth. And those businesses, of course, supported by our very prudent funding and capital positions even after the buyback, our proven risk management approach and our ongoing investment in the platform, in technology, regulatory compliance, etc.
Shemara, thanks so much for joining us.
Thanks, Lily.